Loan growth this whole year really, in particular the last couple of quarters, has been varying because really of payoffs, not so much production. And so what happens is when the long rate goes up, as you know, the 10-year has gone up a good bit recently, then people that have loans that can go to the permanent market on banks' balance sheets, they try to judge whether the rates are going up, and if they think they're going up, then they go ahead and move the loans out. So we've seen in the last couple of quarters a lot of volatility around unusual payoffs, which has made loan growth be hard to predict. And so, this year, this quarter, we did have relatively higher payoffs, but we had very strong seasonal growth in a lot of our other diversified businesses. With BB&T, differently than some institutions, we've been working hard for the last decade in building diversification into our loan book so that when you have this kind of situation where C&I loans are being jerked all around by interest rates, many of our other loan categories are not, because they're not as dependent on long-term rates. And so for us, this was a very strong quarter. Loans up 5.8%. Our production is solid, and we expect to see solid growth as we head into the fourth quarter. Not as strong as the third because, again, seasonality for us is a downdraft in the fourth quarter, but loan growth is overall pretty good.
So as we are, in a higher rate environment and we do see some volatilities in rates going into this current quarter, you expect, just sort of extrapolating from what you told us here, commercial and industrial loans might be a little up and down, volatile, but on the other side of the ledger, the consumer won't be as impacted because it looks like mortgage originations are slowing a little bit.
Well, you got two categories of consumer. Mortgage is a kind of a case by itself. It, a bit like C&I, varies a lot based on what's happening with rates. So when rates go up, we see refinance volumes go down immediately. Purchases not so much. But so mortgage varies with rates very much like C&I. On the other hand, other consumer activities like auto financing, recreational vehicle financing, small ticket items and like lawn care, that kind of thing, they don't vary as much because, people that are going to buy a boat or going to buy a car are not nearly as impacted in terms of the decision as someone buying a house. If you're buying a house, a 30-year decision, rates go up a quarter, that's a big impact on whether you do it or not. If you're going to buy an auto, which is a 3 or 4 year decision, rates go up a quarter, it's not as big of a big deal. So two different categories in retail.
Do you see any volatility in loan demand when you see volatility like we've seen in the stock market?
We don't really see much volatility with regard to loans based on the volatility in the stock market. The stock market, at least my view, is very emotional, very fickle in the short term. And generally speaking, most people don't make decisions based on the short-term fickle nature of the stock market. If you did, you'd wake up in the morning getting ready to go buy a car because the stock market's up, and by 3 o'clock the stock market's down, you change your mind. People don't really behave that way. We get excited about it on TV because of what's going on, but it's not that much in the real world.